Hello, dividend growth stock investors. Happy Sunday to you. Already August. This year has just been flying by for me. It's been very chaotic in the midst of a career change, which has gotten my schedule and my rhythm and all of that stuff totally messed up after being in the previous job I was in for more than 10 years. Definitely have some scheduling and some rhythmic things that I need to get under me to get kind of back in the swing of things. But I wanted to make sure that I got this video out to you guys after taking last week off so we can talk about the stocks that are on sale going into the trading week here this week. Obviously, as you can see here, I think that United Health is having an absolute fire sale right now. I know that there are negative headlines. There are things that you'll want to be aware of if you're investing in United Health right now to decide whether or not you feel comfortable with the risks moving forward. I'm a long-term buy and hold dividend growth stock income investor. So when I'm purchasing a stock, I'm not necessarily concerned with how the next year, 2 years, 3 years are looking for the company. I'm thinking much longer term out than that. So United Health is just one of those for me. I'm going to have shares of United Health for a very long time. Uh, Barring any unforeseen developments. But right now, there's nothing that's keeping me from being a buyer of United Health. You guys will have to let me know what you think of United Health down there in the comments below. Now, I'm not a licensed professional. Do your own due diligence before investing your hard earned money. This should be considered for entertainment. I'm sharing my strategy with you. Hopefully, this gives you some ideas, but none of this should be taken as direct financial advice. Now, what I do with my portfolio every single week when I'm investing new money, I'm putting at least half of it into age appropriate ETFs. So I have automatic diversification. And I am looking for stocks that are yielding 30% or more above their 4-year average yield. I do have a group of 10 favorite stocks that are my personal favorite. I will sometimes just buy those regardless of what the value looks like, because I want to make sure that I have a decent position in these particular 10. And now, what the thesis of the channel is that you take a smaller amount of dividend growth stocks. This channel has 60 stocks that it keeps a track of and analyzes week in and week out. Those 60 are split into 4 separate categories or tiers based on your age and time horizon, which is the most important metric to take into consideration. So we'll look at the tiers here next. I try to stay within my own personal tier, but I do go outside of my age tier range if there are major bargains to be had. For example, United Health is certainly one of those. So let's take a look at the tiers now, you guys. Hop over into the spreadsheet as we do each Sunday, going over this stuff. And I start with tier one, you guys. So 4 separate categories based on your age. Tier one is those 18 to 30-year-old investors who aren't necessarily in need of high starting yield right now, but need very rapid dividend growth consistently year over year. We're talking 1.5% starting yield, well above 10% year over year dividend growth is the name of the game with these stocks. This is sorted by valuation tab, where I am taking that 4-year average dividend yield, which I update every single week before recording this video, and I compare it against the current day yield to see how far off that is. And all I need here is 30% off, you guys. I need a 30% discount off the 4-year average yield before I want to buy anything in my age tier. And I've got 3 stocks that are in that buy zone right now. Nike and Nordson certainly look like very nice deals. They continue to just be stocks that are slumping with 4-year average yields that are gradually ticking up. But right now, getting United Health with a 3.72% starting yield, pretty unbelievable to me. That is basically 160% higher than the 4-year average. This is something that over the course of the last 4 years, you guys, the average starting yield any given day would have been 1.43%. And we are well beyond double that now at 3.72%. So you can buy a lot of income here, you guys, with United Health. And let's not forget, earlier just this year, this was a stock that was trading comfortably above $500 a share, and now you can get that same stock all the way down at 237. I'm kind of stunned, actually. United Health has gotten punished this bad. All right, guys, tier two, age 31 to 41-year-old investors. Starting yields a little higher with this cluster of stocks for these guys. They're looking for 2 to 4% starting yield, 7 to 9% annual dividend growth is what we're looking for here. We've got some options here in the tier two section, you guys. Target remains very undervalued right now with a very high starting yield. American States Water recently did a dividend increase, as you saw in the video I posted here just yesterday, which pushes them into the buy zone pretty comfortably. I love American States Water, just such a steady company. 7 to 9% dividend increases year over year. They're so stable with that. They just did it again with a 8 point something or so dividend increase. They did an 8.22% increase in 2024. So consistent. And then McCormick, another extremely consistent one. Love buying this one when it looks to be trading on the cheaper side. Which it certainly is. And then Hershey has been in my buy zone, one of the stocks I've been buying really aggressively for months on end now. You guys, if you've been here for a while, you know it. Drop a comment below. Let me know if you've been buying Hershey with me, and are you happy to buy it at these levels, or were you like me? Did you load up on a bunch of it in the 160s and the 170s? And now that it's starting to get up into the 190s, you're pumping the brakes. I don't know. For me, it's right there under $190 a share. But wow, it just almost fell out of that buy zone. Next Era Energy, right there where you want it. Maybe you want to wait until it gets right down to about $70 a share before you pull the trigger, but a lot of really nice deals in this category here. Starbucks starting to creep back closer to buy zone category. And then Union Pacific here, you guys, this is one of my personal top 10 favorite dividend growth stocks. They recently did a small dividend increase in July. And, they're not in that 30% range, but they are a bit undervalued. 2.21% for your average yield, currently yielding 2.52% now that we factored in that bit of a dividend increase. So while it's not an amazing deal, I'm keeping a very close eye on UNP, especially if I'm in this tier 2 age range. Tier 3, age 42 to 53-year-old investors, we're looking more at like 3 to 5% starting yield, 4 to 7% dividend growth year over year. Hormel, Archer Daniels Midland, Pepsi are the three buyable stocks in this tier once again. But since Pepsi is in my personal top 10 favorite stocks, it would definitely get the edge from me as far as priority is concerned. And it is a stock that I think is a great purchase right now, regardless of your age range. Getting Pepsi with the starting yield above 4% is so enticing to me. I know that there's some short-term things that are worrying people as far as their balance sheet, their free cash flow, and whatnot. But I think Pepsi is going to get through all of this just fine. I don't think they're breaking their dividend increase streak history. If they have to slow down the dividend growth for a couple of years, I don't mind that as much because I'm getting it at such a nice high starting yield already. Procter and Gamble still right there in the nearby zone for me, but I still think Procter and Gamble is cheap enough, especially if I'm already in tier 3. I might not prioritize adding Procter and Gamble right now if I was younger, but in that 42 to 53 age range, we're in a pretty good sweet spot to just add some to Procter and Gamble as it is right now. We were kind of doing the same thing recently, like with Johnson and Johnson, another one of my top 10 favorites. We were adding that down in like right around $150 a share. And then when it recovers up here into the high 160s, we just we hit the pause button there, just let our drip grow that position moving forward, and then we start looking more at Procter and Gamble in that price range instead. It's really pretty simple, you guys. It's just buying this income when it is giving us the best value for our new investable dollars. Tier 4, the 54 and older investors, still not great deals here, you guys, but we're starting to see some flirtation with value here in this group. Now, for the 54 and older investors, we really need to make sure, with our grouping of stocks here, we're yielding well above 5% and that we're still getting some dividend growth in the 2 to 4% a year range. And we've got some REITs here. Realty Income has been at the top of the list for such a long time now, just week after week after week. Kind of nice to see a different one up here in that top category as Essex Properties has crept up here. And Essex Properties, when the yield on Essex gets up above 4%, right now it's right at 4%, it starts to get pretty attractive because Essex Properties, if you go back and look at the dividend increase history on it, not only is this a dividend aristocrat with more than 25 years of consecutive annual dividend increases, but Essex Properties very consistent with that. They're usually in the 5 to 6% dividend growth range. This is one of the lower starting yield companies in this group of 10, but they're so stable and the growth rate is so solid that it's kind of worth having them here in this spot. They're almost in that tier 3 group of 42 to 53, but I like to emphasize real estate more in the later years of investing, and that's the main reason why Essex wound up here. But if this gets too much further north of 4%, you'll really want to have Essex Properties on your watch list, on your radar. I would want it to definitely get down below $250 a share before I thought about hitting the buy button on it personally. But it's definitely one of those stable, sleep well at night real estate play investments. Also, guys, if you're adding real estate in your Roth IRAs, not a bad idea to have your REIT income coming in the form of a Roth where you don't have to worry about the tax implications. Keep an eye out for Essex Properties as it stands right now. Real quick, you guys, I just flashed by here real quick. This is my personal top 10 favorite stocks. All of these are somewhere between tiers 1, 2, or 3. I'm always looking to add to these stocks if I have any sense that they're even a little bit undervalued. Pepsi, Procter Gamble, and Union Pacific, I'm very comfortable with as they stand right now, Pepsi in particular. In my investing strategy for the week, this is how it would look depending on what tier I was in. If I was in that 18 to 30-year-old tier 1 group for my investable dollars, half of it goes into ETFs, so I'm going to do 25% into the S&P 500, 15 into a small cap, 5% dividend appreciation, 5% international. And then on the other half with my stocks, I'm going to be prioritizing United Health, Pepsi, Nike for sure. I like Nordson and Target for this group of investors as well. A lot of high yield opportunities here for you tier 1 investors. You got a 4%er in Pepsi, in Target, a 3.7 in UNH. There's some yield that you've got a green light to get there, young investors. Tier 2, the 31 to 41-year-old crew, dividend appreciation, S&P 500, small cap, international. And I'd really be trying to spread it out a bit this time as a tier 2 investor. I'm definitely hitting Pepsi and Target, Hershey, AWR, McCormick, UNP, UNH, Nike, all interesting options here for a tier 2 investor. For tier 3, SCHD, VYM, DHS, VYMI for those ETFs, Pepsi, ADM, Hormel, PG, Target, UNH, Nike. UNH, I even would grab if I was in that tier 4, 54 and older category and wanted to add some growth play. Absolutely. It's a high enough yield, and it's maybe not a bad play even for that level of investor. All right, guys, that's the video for the week. Keep on investing.